Right, good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. And Olga, thank you again for that lovely music while we waited to start. Tariffs and the impact thereof are again popping into many conversations, but who knows what will be implemented or exactly when, and it almost appears as if the market are becoming numb to some of this news. How will this impact on global inflation and already slowing growth? And should one consider other developed markets like the UK or the EU? Today, we will have a closer look at the opportunity set in global and SA equities. And on the SA front, more specifically, the SA Inc. basket, well priced but a bit unloved. You may even have questions on developed versus EM or growth versus value, which you know by now. You are welcome to post in the Q&A bubble, and we'll try to get to those questions after both presentations. It's my absolute pleasure to welcome two top equity fund managers this morning that need very little introduction, both with exceptional performance histories. Liam Hector from Anchor Capital, based in London, and Stephen Hurwitz from 361 Asset Management in Cape Town this morning. Good morning, gentlemen. How are you doing?
Morning, Eugene. Thanks for having us.
Good morning.
Thank you both for joining. Really good to have you on this session in a time where we have a lot of questions, I guess, but we'll try to deal with it as we progress. Liam, you up first, and will be followed by Stephen. And to the audience, like I mentioned, you're welcome to post questions, and we'll take those questions after both presentations.
Thanks, Eugene. Assuming my slides are showing up, I'll just kick off one.
Absolutely perfect.
Okay,
thanks a lot.
So good morning, everyone. Just in terms of our process at Anchor, every quarter we sit down, a group of us that form part of an asset allocation committee that looks across the different asset classes and geographies around the world. And we come up with a strategic asset allocation. So I'm principally responsible for domestic equities and emerging market and domestic equities in South Africa. So I just it is the timing is quite fortuitous in that we've just released our latest quarterly asset allocation, so this is relatively fresh. Our views on the JSE and how we've positioned, and this really filters down to how we construct our portfolios at Anchor. In terms of our investment philosophy and style, I mean, I would certainly characterize us as focusing on high quality companies with reasonably good growth prospects. I think that's been a part of our DNA since the start. It's been far more. You've been able to implement this far more accurately offshore than the JSE, just purely from a lack of opportunity perspective. But in terms of the general DNA and golden thread that runs throughout our investment process, we definitely gravitate towards higher quality businesses that have got the ability to grow. Obviously, the South African backdrop makes it quite challenging. In terms of our views at the moment, so coming in, let's just dial it back 6 months. Coming into the year, we were reasonably, and certainly for the second half of last year, we were reasonably constructive on the prospects for the JSE. And when I say the JSE, I really mean the domestic corners of our local market. So that it covers about 50% of the index, but about 80% of the shares that you could actually invest in the cap swing. So it really is the meat of the index, maybe not from a percentage perspective, but certainly from number of shares. And we've got a reasonably big investment team that covers the majority of those shares. So there's a lot of effort that goes into the domestic part of the JSE. I would say going back 12 months ago and certainly 6 months ago, coming into the beginning of this year, there was a lot of optimism around the political change that had happened in South Africa. It was showing up globally as one of the more interesting investment cases, no doubt. With the finally, there's potentially a chance to get some structural reform through and unlock the potential in the economy. I would say what's happened since the beginning of the year until now is certainly the confidence in that investment case has been tested. The durability of it has been tested. So, when we came into the beginning of the year, I think the consensus among the economists that we follow in South Africa, you were looking at north of 2% GDP growth, 2.5%, which for an economy like South Africa, from the base that it's going off, is not actually that impressive. But South Africa has just really struggled to deliver anything remotely close to that consistently over the last 10 years. So where we are now is that GDP growth has been coming back. Estimates, coming into the year, if we were expecting 2.5%, we're probably already down to about 1%. It should be noted that not all of that is due to South Africa. There was a lot of downgrades on global GDP growth, certainly at the end of the first quarter, around the time that Trump came out with his first tariff announcements, and that did have an impact on a lot of the global investment houses' view on South Africa. A lot of the estimates were pared back in line with downgrades on global GDP growth. The actual outcomes of the tariffs will most likely be marginal. I think the impact on the South African economy, it certainly has a bigger impact from a confidence perspective, but in terms of the direct impact, it's not. We haven't calculated it to be overly material. But there are other factors that have remained unchanged, and some things that have moved in our favor. So, we've gone more balanced on JSE equities, but there certainly is still reason to be optimistic, and there certainly are opportunities that are around the market from a valuation perspective, but also the fact that fuel costs have come down. The risk-free rate in South Africa has come in quite handsomely. I think that's having an underappreciated impact on the valuations on our local market, making them a lot more attractive. The fact that our trade basket has moved comfortably in our favor, the oil prices having stabilized to coming off. At the same time that some of our key export commodities have risen. That's been, I think it's helped the currency, the South African rand, quite a bit. You've had that coupled with the fact that the dollar's been relatively weak over the course of the last 6 months. So there are certainly factors that are playing and have in the JSE's favor, and that's certainly in the typical playbook of managing money in South Africa, that would set up the domestics in South Africa for a good, well, certainly a better second half of the year. But so far this year, you've had a reasonably good outcome for South African equities. You've had the index has been up, I think, 16% in the first half. But when you look below the surface, the returns have been extremely concentrated year to date. The next slide just kind of highlights that. So this certainly wasn't our base case. I would have said if you looked at our total return expectation coming into the year, I think we were in the mid-teens, and we still had the domestics leading the pack there. The outcome so far this year couldn't be more different. So you've got domestics, which are largely been stuck in the mud. It hasn't been a disastrous outcome. There's certainly been a pullback in certain places. Particular focus on discretionary retail, where the expectations maybe were a bit high coming into the year. But the domestics have really been the laggard across the market year to date. And even that positive return, that contribution of 1.3%, that's all the telecom sector and telecoms. And I mean, that certainly was, again, not part of our base case coming into the year. The basic materials, which is largely a function of precious metals, platinum and gold, PGM and gold, that really has been an unbelievable contributor year to date for our local index. And then once again, South African investors can cheer the fact that Naspers and Prosus exists on the JSE, because it's been another healthy contributor to performance this year. A better slide that really discusses this lack of breadth is this. So this is the capped SWIX, the investment universe. That blue line is what the index has given you this year. And this slide basically shows how many shares have underperformed the index, how concentrated returns have been in a small number of shares that have provided the majority, if not all, the investment performance for the index this year. So this in our view, this is not a healthy situation. Let's just start off by saying that. Last year the picture was very different. In fact, you had a big recovery in the domestic part of our local market as GDP estimates were taken up. But this is a first half story. We think that there's certainly an argument to be made that better relative value is now sitting in the domestics on the JSE. Things like banks, we think are offering reasonably good value. It's just very difficult to get overly excited about those investment cases and be very confident that you're going to get the performance when you've got this kind of situation happening, where coming into the year, that in the far right of that, this is GDP estimates, that dotted line at the end of December 2024, so the end of last year, and that red line is where the estimates have crept to now. So in the far right of this chart, you can see how those estimates are being pared back. Very difficult to get excited about wanting to own equities for growth in an environment where the economic conditions are not necessarily giving you that rising tide to lift all the boats. That being said, I think, sorry, just one more slide just to show that how confidence has actually been dented since the start of the year, which has been very frustrating, because I think South Africa was in a very positive place coming into this year. You had a lot going in its favor, and it just seems like that has been deflated as the year has progressed this year. And I mean, it's just I suppose South African investors are now used to this type of phenomenon happening, having seen it in the past. Just another comment that while there's reasonably good value across the domestics in South Africa, we're certainly not in that bombed out what we would just sort of call no-brainer territory. So we're certainly not in a place where you want to close your eyes and just buy things. If that GDP number had to pick up and economic conditions were getting better, I think that this would be an unbelievable setup. But we're not necessarily at the close your eyes and buy territory yet for domestics on the JSE. They look like reasonably good value. And that's how we are positioned. So we're not overly concentrated in them. But going back to our original playbook on the JSE, we've been able to uncover and back certain investment cases. The South African markets as we're back into that very selective phase of the market where we've taken a view on certain companies with their ability to grow. There's certain characteristics that they have, and I mean these are just some of the names that have done well for us this year, and I mean it's worth highlighting. So us as I've mentioned, us as a process, very difficult for us to have big weights and things like golds and platinum shares. But we've been able to keep up with the index performance largely, give or take a few percent this year, as a result of the sort of industrial businesses and financials that we've got, with clear growth prospects and a clear trajectory, and these stocks have been rewarded, and it's largely and us keeping up with our peers and the index performance is largely a function of these companies having outperformed and given us some reasonably good relative performance this year. So those investment cases in South Africa where there's a strategic path for it, the companies are able to execute in a very tough environment, produce reasonably good growth. We are prepared to pay up a little bit more for those companies. We don't ignore the more cyclical parts of our market, so the basic material sector, we certainly don't ignore that, but we just maybe neutralize underweight as opposed to go materially overweight there. But yeah, I mean, we've been able to, at least South Africa is still producing reasonably good companies. It's a shame that we're not producing many more of these. We think we've got there's certainly the potential for the country to produce them. There's the management capabilities and certainly the desire and the business models that exist there to take advantage. But for now, we're in the mode of backing clear opportunities, companies that have got a competitive edge in terms of what they're doing and are able to execute in a very tough environment. So that has stood us in good stead. It's consistent with what we've done for the last, I think our track record in this space is now over 13 years. And it's just a formula that's worked for us over time, and we'll continue to stick to that. That's me, Jim. My time's up.
Liam, thank you very much for that. Indeed, I'm going to come back with a couple of questions that came in from the audience. But before we do that, Stephen, you're up next. If you can start sharing your slides.
Perfect.
Yeah, your
Thanks,
slides coming
Steve.
through. I can see them. Perfect. Yes. Thanks, Stephen.
Great. So a question that we often get asked in our multi-asset portfolios is whether offshore markets are too expensive, and it doesn't still make sense to have most of our offshore equity allocation in the US. So just to start, having a look at the S&P 500 forward PE ratio, it does optically look very expensive relative to history. We're close to the levels that we saw in 1999, 2000, with the bubble there. And then we're also close to the levels that we saw coming out of COVID when the market really took off. Now, I guess the big question is, does this impact returns? And the next graph for me is really fascinating. So on the left, you've got forward PE ratio versus 1 year subsequent returns. So your returns on the y-axis and the PE ratio on the x-axis. And then on the right, you've got the exact same, but with 5 year subsequent returns rather than 1 year subsequent returns. And then you have the R squared, which is the amount that the PE ratio explains the subsequent returns. And what's fascinating is that over a 1 year time period, there's very little, basically zero predictive value of PE ratios on subsequent returns. However, as your time frame goes longer, it does start to have more and more predictive value. So over 5 years, the PE ratio can explain about just under 30% of your subsequent returns. And as you even take that further, the R squared starts explaining more, it starts picking up. So your PE ratio starts explaining more and more of the return. So as you approach 10 years, it would be even higher than that 0.28. So what this basically means is that if you're selling now your US equities, it doesn't necessarily mean that you're going to do well. It's not a great market timing tool, pure valuation, but over the long run, it is important to pay attention to. Now, what's interesting is that people often say to us, if you weren't in US tech, you didn't do well. You had to be in, the likes of Alphabet, Nvidia, Amazon, Netflix, Meta. And this graph actually shows you that US tech hasn't been the only game in town. So what's interesting is that the graph, the red line is actually your US FANGs, your big tech stocks. And the gray line is the Eurostoxx Banks Index. And it's outperformed US big tech since July 2020. And there are numerous reasons for this. Starting valuations were extremely low, but also European banks have been completely starved of positive interest rates for many, many years. And coming out of COVID, as we started to see interest rates pick up, these banks started to get a bit of a lifeline. And we've really liked many of the European banks. They've been very well capitalized banks that have had good capital return stories, both in terms of dividends as well as share buybacks. And also there are pockets of growth in the EU that we think are very interesting. So for example, we think that Greece is a great story. Greece had one of the most severe recessions in the last 30 years, and their unemployment rate picked up to over 20%, and now it's just a couple of percent above France's. Their debt to GDP has been coming down at a rapid rate. It's still the highest in the Eurozone at over 140%, but they have a primary budget surplus, and that's coming down extremely and that's what's causing the debt to GDP to come down extremely quickly. So we think that Greek banks are extremely well positioned to benefit from this. And I think it also just shows you that where there is political will, as dire as the situation seems, there's definitely opportunity for things to get better. So, in South Africa, that's what made the promise of the GNU seem so interesting for a lot of investors, ourselves included, because it meant that potentially for the first time in a long time, there would be some political will to get the economy growing. Unfortunately, that hasn't panned out, but it does show you that, all is not always lost, even though it might seem that way. Now, does that mean that we're positive on the Eurozone as a whole? I wouldn't really say so. I would say we have to look for pockets of opportunity. On the left, you see the ratio of the Euro Stoxx 600 to the S&P 500. And as you can see, it's consistently underperformed since 1990. And the main reason for this is actually just earnings. US earnings keep outpacing European earnings. This year, you started to see the Euro Stoxx outperforming the S&P for the first 3 months of the year. And then it reversed. And you can see that one of the main reasons why it has reversed is that the S&P 500's estimated earnings per share has continued to rise, while the Euro Stoxx 600 has actually flatlined. And for us over the long term, share prices are driven by earnings. And I think that's why you have seen the European index really struggle. Now, what are some of the reasons for why this has been the case? We think there are a couple. So firstly, demographic issues. I think that the Eurozone is really struggling with the demographic problem here. On the right-hand side, you can actually just see a butterfly chart of what the Eurozone population looks like by age. And as you can see, there are fewer and fewer young people. And as a result, this has pretty big implications for both GDP growth, but also for how people think about stocks. One of the most popular and successful ways of investing over the last couple decades has been buying consumer staple stocks, very strong entrenched brands. But I'm not so sure that that works going forward, and mainly because with populations declining, you're going to see pressure on volumes. Will emerging markets, and as they become a little bit wealthier, be able to offset all of that pressure? It remains to be seen. But those consumer staples companies that have most of their revenues coming out of developed markets, I think they're going to struggle as their volumes come under increasing pressure as populations age and actually start shrinking in those geographies. The second big issue for the Eurozone is regulation. You can see that they're more focused on making sure that the bottle cap doesn't fall off their water bottles, as opposed to actually trying to get the economy to grow. So when it comes to AI, Europe is a first, but not in something that they necessarily are proud of, and that's regulation. So while the rest of the world, the US and China are trying to get ahead by deploying artificial intelligence and increasing productivity, the EU's rather trying to regulate it. And from a couple of the companies that we've spoken to, they actually are quite disappointed in terms of the EU stance. And then this feeds into one of the other issues that they have, which is energy. And we could see that with the Russia-Ukraine war, just the Eurozone's dependence on Russian energy. But the big problem is energy prices. And I think a large part of this is actually the drive that the EU's had in terms of renewables, both wind and solar. It's made their electricity costs very expensive relative to the rest of the world. So you can see there that Britain's the most expensive for industrial electricity, then France and Germany. And this is going to mean that even if they wanted to become leaders in AI, it's going to be very difficult for them to do so, because AI is extremely energy intensive. And as you can see in the chart in the middle, that's projected US data center energy consumption. It's forecast to grow over the next decade. And it's going to take increasing share of US power demand. So I think that the EU is going to find themselves at a competitive disadvantage when it comes to AI. A lot of companies aren't going to want to put up their data centers in the EU, just because of the huge amount of cost that energy makes up in terms of AI inference. So how are we currently positioned for this environment? What we've done since the end of last year is that we reduced our exposure to SA equities pretty significantly. We've been using some of the rand strength to take our offshore allocation up. But given our concerns over some of the valuation issues, we haven't completely deployed that into equities. We think that we will get more attractive opportunities. So we did increase our equity exposure, but we're still sitting on a little bit of cash offshore. Just looking at the portfolio split at the end of last year, our SA Inc. exposure, so that's exposure to the likes of SA retailers, banks, industrials, that was sitting at close to 50%. We were quite positive on the GNU when it came in, but we decided at the beginning of the year to cut our exposure dramatically. We just weren't seeing the reforms that we wanted to see quick enough. Perhaps we'll get another opportunity to take that up again, but I don't think that valuations have completely returned to the pre-election levels, where we started to think that even if the worst case scenario materialized, there was still significant upside in those names. We continue to think that there are lots of opportunities offshore, but we don't have a strategic asset allocation. We make use of using a bottom-up view and then having a look at what meets our minimum return target hurdles. So the sectors that we think look very interesting at the moment, both banks, we like some of those European banks I mentioned earlier, but a lot of the SA banks have actually returned to very attractive levels in terms of their valuations. We think the likes of an ABSA, for example, you basically get paid to wait while things improved. It's on like a 9% dividend yield. You only need 4-5% earnings growth in order for you to get like a mid-double-digit total return. Then on the side of technology, that composes both Chinese tech, so Tencent, Naspers, and Prosus, and then some of those big tech names that you're all familiar with. That's all from me.
Stephen, thank you very much for that. I mean, while I've got you on the line, I'm actually going to start with one or two questions for you. And I mean, it almost starts with currency. And if you looked at what happened to the rand and the dollar over the past couple of months, you might mention of that now as well. But if you look at the US dollar, I mean, is this telling us that there is perhaps something wrong with the US economy?
What's interesting is that there used to be a very tight relationship between US and European yields differentials, and that would often dictate the level of the Euro USD. And since the Trump tariffs have come in, that relationship has completely come apart. Whether that's going to sustainably stay this way is anyone's guess, but I don't believe that the US economy is in as bad shape as people necessarily think. We'll have to start seeing now during earnings season in the US if companies are worried, but I believe a lot of export-focused companies are going to take the margin hit. US is still the largest consumer of those goods, and I think that companies are going to want to try and maintain their markets. Trump's only here for a couple of years, and a lot of companies might just be willing to say, you know what, we take the 2 or 3 year margin hit, and then when someone else comes into the US, let's not completely destroy our access to that market. So we're willing to take the short-term pain. And you can see it with Toyota. Toyota basically has decided to take their margins down in order to continue supplying the US economy. I also think that certain countries are going to want to devalue their currency in order to restore the competitiveness of their exports to the US. this weak dollar is actually hurting a lot of these other export economies significantly. I think Eurozone earnings are going to be under pressure given how important exports are to the Eurozone. The strong euro isn't good for them.
Indeed. Leon, while we're on currencies, there was a question that came in from the audience while you presented. What is your opinion on the value of the rand for the future, taking into consideration the collapse of the ANC?
Sure.
Yeah.
So, yeah.
That's a
Listen,
statement, isn't it?
yeah, I mean, I think South Africans most likely will have to come to terms with the fact that coalition politics are going to be around for a while. There's certainly daunting aspects about the fact that the ANC is dipping as hard as they are, but there's obviously on the other side there's if political parties are going to be rewarded for governance, then that could also be a good thing. I think in South Africa it's clearly a trend that kicked off probably in 2004-ish of fragmentation across local politics. And that seems to be a trend that's continued with I think the MK party that came about last year. So yeah, I'll be honest with you, we get very distracted by local politics when looking at South Africa. I think that's sitting in London. Having looked back at South Africa for the last 8 years and looking at it in the context of EM, there's a lot that South Africans get fixated on politically, where a lot of the time the factors that are influencing the currency have actually got little to do with that. Right now, I think that there are much bigger factors at play. I think what Stephen was discussing around the dollar, that's very important. And then obviously the fact that South Africa does have key exports, and our exports are seem to be in a bit of a purple patch right now. It's very short term, very difficult to determine how sustainable that is. But right now, our terms of trade are pretty positive, and South Africa has got. One of the issues on the JSE is South Africa is sitting with some of the highest real rates globally. We've got our bonds are yielding, just under 10%. Inflation's very muted, 2-3%. You're sitting at very high real rates, and our bonds and currency in that context looks really, really attractive globally. So my message, and it comes through clearly in our investment process is be mindful of what's going on in local politics. It certainly has a big influence over the short term when you see guys using the currency almost like as a stock that represents the economy. But over time, we've come to realize that there's so many different factors that come into play with the rand. That just purely getting overly fixated on local politics, which I'm sure all the listeners and investors in South Africa are quite sick of by now after so many years of being disappointed by our local politicians. So yeah, I think let the main thing be the main thing, and focus on the real important stuff, I suppose.
I think you need to hit a nail on the head, focus on the real important stuff, and don't let the news flow confuse the facts.
You'll go crazy. Let me tell you, it's the same in other countries as well. It's not just South Africa that everyone feels dejected half the time by politics. It's all over the place. That I can assure you.
Yeah, and I mean you're 100% right. You mentioned a couple of those points in your presentation as well. If you you focus on the companies that still has good earnings that can still make money for clients. But I mean, let's just look at SA. We're already in a low growth environment, and let's talk a little bit about tariffs. I mean, we're back to the 30%, and then Trump mentioned additional 10% for the BRICS, and now we also know that the S is not Spain. But I mean that will most definitely have an impact on SA's growth going forward. We've got very high unemployment numbers, but how will all these things impact, especially on SA Inc. stocks?
So I mean, if assuming the question's directed at me, because
Yeah,
I'm
Leon,
chatting about
sorry.
this, the it's just so disappointing to see that we're back into this environment of 1% GDP growth, right? I mean, we've been really operating in this environment for so many years now. It's almost as if those companies that have adapted to the circumstances and the environment, some of the companies have gotten better. The sort of the top companies seem to be separating now. There certainly seems to be that dynamic happening. This is certainly not an environment where I think I used the term earlier, the rising tide is going to lift all boats. This is going to be you're gonna have those companies that are executing well and are able to deliver on a strategy that makes sense and resonates with the end user. And then also interestingly on the JSE, there's a lot of investment cases that rely on self-help. I mean, there are certainly businesses across the market that have been run incredibly poorly in the past, and you've got some of the old hands there to rectify and simplify and correct issues. And so almost as if you can get a reasonably good investment outcome with very little top line momentum, just purely by shutting loss-making divisions or I suppose rationalizing things and right sizing. So from that perspective, I think importantly and encouragingly, we're still able to build portfolios that are able to capture some of that. But as I said, frustratingly and disappointingly, it doesn't appear as though you're getting that wave of structural reform potentially happens over time, but certainly not happening very quickly. But with a bit of the tailwinds that a real structural reform would give you, I think our stock market would be in a very different place right now. I mean, a lot of us have got memories of what the South African stock market is capable of in an environment where the country is being managed correctly and the business environment is conducive to growth. Yeah.
So many true comments there. Stephen, if I can maybe pass the next question to you. And I mean, let's stick to the topic of tariffs, because I mean, it keeps on popping up in all the conversations again, like I mentioned in the introduction. Yeah, we can't keep up with what Trump says and what will be implemented when. We still don't know. But we know there's going to be tariffs that will be implemented. I mean, surely this will have an impact on global inflation. Are you concerned about inflation maybe ticking up again?
Yeah, look, it depends, I think, on what happens as well to demand. So you could have tariffs come through, but demand drop off, and then it doesn't necessarily result in an uptick in inflation. And in fact, you could actually see a glut of products that were bought ahead of these tariffs that they need to be sold. So I'm willing to have a pretty open mind and see what happens going forward. Obviously, the risk is that inflation does start picking up, but it will be on the core goods. So we'll have to see what happens on services. If the services inflation remains where it is and goods inflation ticks up as well, then there definitely will be inflation for the US, which will mean that Trump's going to throw his toys out the cot, because it's going to make it very hard for the Fed to cut. And I think that's what he's most interested in, because not only would it help them with refinancing a significant amount of debt that's maturing every year now, but I think he measures his performance based on the stock market, and I think he would love it to retire. But yeah, I mean, we'll have to wait and see, to be honest. I think it depends on, like I said earlier, do foreign exporters take some of that margin hit? What happens to demand in the US as well? There are multiple things at play. Some of the estimates we've seen says that it will increase inflation by up to 0.5%. I mean, it's not exactly huge numbers.
Yeah, and I mean the big thing is we're back again to a position where we are data dependent. But I mean the point you made is that it's going to make it more difficult for the Fed to cut. And Liam, this almost speaks to one of the questions from the audience as well. We know that our Reserve Bank don't really want to cut. If the US don't cut, we don't cut. So the question from the audience member is the Reserve Bank not strangling the consumer? And if we've got no cuts, how will this impact on SA's growth?
Reserve Bank's been strangling the South African consumer for a long time. So it's certainly not something that we wake up this morning with that conclusion. I mean, there's no doubt that one of the uh, I don't know if it's unintended or intended, but one of the consequences of keeping real rates where they are now is that the consumer suffers. I mean, there's no doubt about that, and there's obviously a lot of room for them to cut, but all the communication is there that they're looking to reduce the inflation ban. So that's, I mean, just I suppose price that in. It's going to happen by the looks of things. So it's going to take a bit longer, I suppose, and potentially it's going to be a bit of a shallower cycle. But in terms of the outcome of keeping rates as high as they are, is that the consumer suffers. It's a tax. It's essentially a tax. I mean, if you cut interest rates, it's money straight into the hands of certain consumers, and not the entire consumer across South Africa. Not everyone's got a mortgage and a credit card, and a car loan. But yes, I mean there's no doubt that that's an issue. It permeates across the market. I mean it has a huge issue on your ability to price local stocks in terms of what PE multiple or price to book that you're prepared to pay for them, and obviously starves growth. And as equity investors, that's what we're there for. We could just buy bonds if we're not interested in growth.
Yeah. Liam, another question from the audience, and it speaks to our inflation target going down to 3%. What will the inflation target in SA to 3% have on the potential capital appreciation of stocks, and is there a correlation?
Listen, there's no doubt that what's going on is proving that I suppose the Reserve Bank is independent, which is a good thing in South Africa. I think it also one of the positives that you maybe get out of that is that over time it reduces the government's ability to recklessly expand the balance sheet. So I think that it's been some of the positives are there as signals to the market as well. The impact on local stocks, we don't see it as negative. Obviously, certain companies are going to take advantage of inflation more than others, which is a consideration that we have. But over time, if you can keep inflation in line with the more, I suppose now the new normal in the developed world is that sort of the 3% level, and you have a fairly stable regime there. I think that's ultimately over the longer term with lower rates will be a positive. Yeah.
Eugene, maybe
Thanks
if
for
I
that,
can just
Stephen.
jump in.
If you want to,
I mean,
yeah.
one of the big issues I think for South Africa is interest rates that are just way too high. If you think about the average consumer, for them to own a house now when real rates are running as high as they are, it makes it completely unaffordable. And then that also has knock-on impacts on the economy. So, if people could afford more houses, you'd see more housing development that results in more construction, that results in higher jobs. A lot of countries, a huge portion of the consumer's wealth is invested in their houses. I think it's insane, actually, the level of real interest rates that we're running in South Africa. And I think that the SARB's responsible for some of this lackluster growth that we've seen over the last couple of years. I think their intentions are completely misplaced.
Definitely that. Stephen, just going back to your asset allocation, you showed a slide on that. You took advantage of the stronger rand to up your global exposure. But just more specifically on your global exposure, and again, it speaks to one of the questions that came in from Sean. What does that regional allocation look like? Are you still predominantly in the US, or are you starting to look at not only developed markets, but also some emerging markets, perhaps?
So most of our exposure is in the US on the offshore side. I'd say about 75% or so. We do have some exposure to the UK and Europe. On the developing market side, we would love to have more exposure to the likes of India, but it's very difficult to get accounts opened in India. It's almost impossible. So that's not exactly possible for us. And then in terms of a lot of the other emerging markets, I think they have emerging market issues that don't look particularly attractive. We do like one or two Brazilian tech companies, and we have small exposure there. But a lot of the reason why emerging markets have underperformed for such a long period of time relative to the rest of the world is that earnings haven't grown. And I don't necessarily see a bunch of emerging markets out there that have good governance that makes us interested in investing in those markets. So I would rather invest in companies in South Africa where we understand the dynamics significantly better, and we do have an edge and can deliver alpha as a result of that.
Liam, while we're on the topic, I mean, you run a couple of flexible mandates as well. Your regional allocation on the global side, maybe just give us a quick idea as to what it looks like, and if anything changed significantly over the past 12 months.
No, what I would say is that the exposure that we do have outside of the US has done extremely well. And I don't think we've, I think in a similar way, we haven't made a decision to move away from the US specifically. We've always had an allocation. I mean, I run a emerging markets long only fund as well. That sits as an allocation of that. There hasn't been a material change to that allocation. We've added one or two individual counters outside of that to our global equity portfolios. I think there's been I think TSMC was added, which does, but again, like I don't even know how to classify that as specifically emerging markets. Obviously, it carries with it quite a bit of risk. If China decides to invade Taiwan, that would be an issue. In terms of the exposure that we've got outside of the US, I mean, we were very fortunate to have last year, I think around about the middle of last year, we moved a bit into Europe, and we've done extremely well out of that. And if you look at the performance of our offshore portfolios this year, there's been an extreme outperformance by them, but it wasn't a case of taking a view that we think ex-US is going to outperform now. It's just that we've had a very good run from a stock selection point of view. So we were middle of last year in European defense names, and that's been very good for those portfolios. And then at the same time, listen, our US exposure continues to do well. And I agree with what Stephen was saying in terms of not wanting to necessarily back very poor quality businesses in regions that we are not overly familiar with, just to satisfy a strategic asset allocation view. It certainly is still very focused on the bottom up in terms of how we construct the equity books offshore.
Agree with that. So, Stephen, very last question, and we actually saw this coming up in one of big international analyst companies. And if you look at the flow of assets being allocated to different markets over the past 6 months, and you look at the data, the question almost then comes up: is the US dollar becoming a risk of currency?
I think that the US dollar has always performed very strongly in two scenarios, and that's why they call it the dollar smile. So either when you have like an extreme risk off scenario, global recession, it strengthens, or when the US economy is doing really well and stronger than the rest of the world. And in both of those scenarios, you see the US dollar strengthen relative to the rest of the world. Where the US dollar is relatively weak, it's when the rest of the world is doing well, or the US is doing slightly weak relative to the rest of the world. So I don't think that's a new phenomena. I think that's always been the case where there's been a flight to safety, the dollar strengthens.
Very, very last question, and either one of you can take it. Very quick views on gold. I mean, if you were to position a little bit more defensive, would you still allocate to gold? Is gold as high as it can go? Can it go higher? Do you hold any in your portfolios? Either you or Stephen or Liam, more than welcome.
I'm happy to give it a bet, and then Liam's welcome to add in. But I have no idea what the gold price is going to do. we've always held a percentage of our flexible portfolios in gold. I think it gives you diversification benefits. It has different correlation to other assets, and it's done well as a result of that. So we'll always have a portion of the portfolio in gold, but for me to try and forecast what's going to happen to the gold price, I can't say I have any edge.
Yeah, I mean, I certainly, I think if you, if you listen to what I said at the beginning in terms of our investment approach and philosophy at Anchor, it's very difficult for us to get, for us to profess, also to have an edge on what the gold price is going to do. I will add that something that has been beneficial to our process over time has been in the last 3 or 4 years has been adding an element of like a bit of technical analysis on it as well. We've got a quant that we've employed at Anchor that's helped with us, helped us with it. But we haven't actually invested in gold per se at Anchor. We've invested in some gold producing businesses and done well out of them. But again, focusing on the earnings momentum of those companies as opposed to trying to predict what the gold price is going to do, and it's not it's an uncomfortable position, I would say, for us.
I tend to agree with that. Stephen and Liam, we've actually exhausted our time. We've had really good conversation. There's a couple of more questions. We can try to answer some of the stuff offline and get it back to our audience. You've made a very, very interesting conversation. I think we covered a lot of ground. And I mean, if we look at the performance history of a couple of your mandates, both within Anchor and 361 over longer periods, I mean, you've served your clients or our clients extremely well. So again, thank you for the fantastic work you and your teams are doing. It's really good to see all these things come together. And again, thank you for your time this morning. It's been really great having you on. And we will hopefully see a lot more of both of you in the next couple of months and sessions to come. Thank you so much.
Thanks.
Thank you.
Thanks, Eugene.
Right. To our audience out there, quick reminder, next week, Wednesday, again, back for boutiques on Wednesdays, where we've got Hollard Investments and Thornbridge Investments. And then on the 24th, which is a Thursday, just a reminder, we're continuing with our hedge fund webinars. So we've got another hedge fund webinar coming up as well. Looking forward to seeing you all back on the 23rd. Thank you so much for joining and your continued support. We remain grateful as always. And to the BCI team, thank you for setting up all these sessions. It's always great. Thank you.